See, today we are going to start with irrecoverable debts and allowances. So,
Hello?
hello,
I can't hear you. Your voice is lagging.
my voice is.
Lagging.
Now is it clear?
Yeah, it's better now.
Yeah. See, our topic is irrecoverable debts and allowances. Okay. So
Okay.
two things we have to study in this topic. First thing is irrecoverable debts, and second thing is allowances.
Yes.
So first we will check what is the meaning of this term irrecoverable debts. Okay. Now I'll tell you about irrecoverable debts. See, basically when we do business, okay. In business we know now we make credit sales. Every business makes credit sales. Okay. When the business makes credit sales, in return they will incur receivables. Do you agree with that?
Yes.
Okay. Now, receivables will not pay immediately. They will pay after some period. So, this is basically in every business we see that some of the some of the receivables, they fail to make the payment. Okay. And when this persons who should make the payment didn't make the payment, the debt, that means what is the debt? Debt means the amount which is to be received from them. The debt becomes bad. Okay.
Okay.
So that becomes irrecoverable debts because by that time we understand that we are not going to recover the debt. Okay. So whenever we start with a business, according to principles of business, according to prudence concept, we can say. There's one concept in accounts, that is prudence concept. This says that if you are aware about your losses, what losses you can incur, you can show those losses in your business. Okay. So that is what is the concept of irrecoverable business debts. Okay. So here introductory part is given, like very few business expect to be paid immediately in cash. Like some business, suppose if the business makes a policy that they will always make payment, they will always like sell goods on cash, definitely they will not be able to increase their sales, because sometimes people, they want credit. Okay. So that's
Yes.
the reason many business, in order to get the benefit of extra sales, they provide this credit facility also to the customers. Okay. But one thing is always to be remembered, that when you are providing credit facilities, you should keep 2-3 things in mind. First thing, you should receive the money from the customers as quickly as possible. Okay.
Yes.
Second thing, you should put a credit limit on the customer, like this is the amount which up to which I can give you credit. Beyond that, I can't give you credit. Okay. And for that credit control is to be followed. Okay. So what is credit control? This is aged receivable analysis. Aged receivable means some of the receivables which has become long due. Some receivables which has become long due, those are to be recovered from the customer as quickly as possible. Otherwise, there are chances of losing those receivables. Okay, so here one example is given. Aged receivable analysis is a report of all receivables analyzed by customers by age of the receivable. What do you mean by age? That means by, up to how much time, till from where, when this has become due. Okay. Like balances outstanding for 30 days, for 60 days, for 90 days, and so on. When the balance has been outstanding for a long period of time, we understand that the customer has no more intention to make the payment. That means customer will be unable to pay. So that ultimately that thing becomes irrecoverable or a bad debt. Okay. Now, why do the customer fail to make payment? Sometimes out of dishonesty, sometimes they have faced some issues like they have gone bankrupt. Okay, so that's the reason they are unable to pay. Okay, so the cost of offering credit facilities. So when business is trying to increase their sales by offering credit facilities to customer, business is incurring some kind of cost also for that. What are those costs? First cost is interest cost on an overdraft. See, on a daily basis, business too has some expenses. Okay, like when we are doing a trading business. Okay, so in trading business, we purchase from supplier. So we have to make payment to the supplier.
Yes.
Then we need to keep some workers. We have to make payment to the workers even. Okay. So some amount is required on a day-to-day basis to be paid by the business. And if business is not receiving money from the customer, at the end, business has to take an overdraft facility. Do you know what is an overdraft? Are you aware about the term overdraft?
Hello.
If not, I will just answer like, what is overdraft? Overdraft is, we can say this is a facility given by bank. Okay. That means like you have certain amount in your bank account, na? Like suppose you have some $5,000 in your bank account. Okay. Now you are in requirement of some $5,500. So extra $500 you can overdraw from your account. That means you can withdraw more than what you have in your account. That facility is given by banks to business enterprises, because in business we know now sometimes the expenses can be more, sometimes income can be more. So like if suppose customers are not making prompt payment, business has to take this overdraft facility from the bank. Okay, do you understood?
Yes. Yes. Now.
Second kind of expense is cost of trying to obtain payment. So like regularly when we are reminding the customer that you have to make payment, you have to make payment, someone has to get involved in that. So we have to pay salary to that particular person who is always reminding the customers to make the payment. So that is the cost of trying to obtain payment. And third thing is court cost. So ultimately when the customer is not paying, we have only one option left, that we have to approach the court. We have to file a case against that particular customer. Okay. So that is the court cost involved. Okay. So for one reason or another, the business might decide to give up expecting payment and to write the debt off. So later on, even after all these things, all the things done by the business to recover the payment, the business doesn't receive payment. So at the end, they have only one option, that is to show the debt as bad debt. And when a debt becomes bad, we have to write it off. Write it off means we have to show it as a loss in statement of profit and loss. Okay, so that was the concept of irrecoverable debt. So coming to the definition, irrecoverable debt is debt which is definitely not expected to be paid. It could occur when a customer has gone bankrupt. So that is one valid reason. Since the customer has gone bankrupt, he is unable to make payment. Okay. And once we have incurred a debt as bad debt, we have to show it as a loss in statement of profit and loss. Okay. So that is ultimately the accounting treatment. Now we'll check the accounting entries, how entries are to be followed. So we know we will start from the beginning when the business is making a sale to the credit customer. So whenever the business is selling on credit, your journal entry part is done, na?
Yes, ma'am.
So you will be able to understand this. When a business is selling on credit, what is the entry to be passed? When sales are on credit, sales is an income, na? Income is a liability. So increase in income will be shown in the credit side, and receivables is an asset. Increase in asset will be shown in the debit side. So the entry will be debit receivables, credit, sales. Okay. Sorry, increase is not increase in liability. This is increase in income. So debit receivables, credit sales. Now, all being well, a few weeks later when the customer makes the payment, okay. So in that case, we have to close this receivables account. So that's the reason we will show now when payment is received. Here again, there is increase in asset, that is cash is increasing, and there is decrease in asset, that is receivables account is decreasing, okay. Suppose to make it more easier, we'll put amounts also. So there has been a $50 receivables account created, okay, because we have made a sale of $50. Now after a week's time, we received that $50. So our cash reserve has increased by $50 and our asset has decreased by $50. So that's the reason decrease in asset is shown in the credit side, okay. But what happens if instead the customer goes bankrupt and he can't pay? So in that case, like we have to follow the prudence concept. Like an asset is a source controlled by an entity from which future economic benefits are expected to flow. Na? So the day till the day we were expecting payment, we were showing it as an asset. But the day when we come to know that now we will not be able to recover the receivables, we have to stop expecting payment from that particular person. So when we stop expecting payment, that means it's no more an asset because it is not satisfying the definition of asset that future economic benefits will flow to the entity. Do you agree with that? Hello, are you following?
Hello? Yes, ma'am. I'm replying.
Yeah, okay. Your voice is too low. I was unable to hear. Okay, fine. So yeah, from that day, we will not show it as an asset because it is not satisfying the definition of the asset. Okay. So now the ledger entry will be what? Debit irrecoverable debt, because now this has become a loss. Okay. And losses are debited in SOPL, be it losses or expenses, and credit receivables. Anyhow, there is decrease in asset, no? So decrease in asset is to be shown in the credit side. And that will be, so this part will be shown in SOPL, this part will be shown in SOFP. So this irrecoverable debt will have an effect on both the financial statement. It will be shown as an expense or loss in SOPL. It will be shown as a decrease in receivables in SOFP. Okay. So now we will solve one question. This is the question. Design company has a total balance for receivables of 25,000 at year end. Remember, total receivables are $25,000. A review of receivables highlight that one of its customer, Man Company, has gone bankrupt. Now from them we are expecting, the design company is expecting $4,000. Okay. Now so this $4,000 has become irrecoverable, that means bad debt. Okay. Now, so what is the balance for trade receivables to be shown in the statement of financial position at the year end? And what is the irrecoverable debt expense to be shown in the statement of profit and loss at the year end? Okay. So two things we have to show. Now, how to show this? When we prepare this irrecoverable debt account, okay, this is a asset account, remember, when we are showing it in SOFP. Opening balance of asset will come in the debit side, closing will come in the credit side, okay. So opening balance as given in the question. Opening balance given in the question is 25,000. Now, irrecoverable debts, decrease in asset is by how much, and decrease in asset will be shown in the credit side by how much? 4,000, because this has become irrecoverable. So ultimately our closing balance becomes 25 minus 4, that is 21,000. Clear?
Yes.
So this 4,000 will be shown in SOPL and this 21,000 will be shown in SOFP. Okay?
Yeah.
So same has been explained here. This example is clear?
Yes, ma'am.
Okay. Now we'll move forward. Another example I'll leave for you for practice. Okay?
Yeah, okay.
Now one more thing is happening now. See, irrecoverable debts written off and subsequently it is later on paid. Okay? So written off means we have shown it as a loss by that time. Okay? But in the future, unexpectedly we receive the payment. Okay? Now, so when the debt has been already written off, we don't show it in SOFP anymore. Cash received cannot be offset against it in the usual way. So again, with respect to that, if we are receiving cash, we can't adjust it in receivable because already we have written it off as a loss. So the cash received is offset against the irrecoverable debt expense account. So where we can adjust it against the irrecoverable debt expense account. Okay. So regardless of when the payment is received, the ledger entry will always be now debit cash. Cash is coming in, na? So cash is coming means there is increase in asset. Okay. And we have to, previously we have shown irrecoverable debt in debit side. Okay. Irrecoverable debt was shown in the debit side. Now we have received the payment now and that has increased the cash. So now we have to close the irrecoverable debt expense account. So that will be credited in order to cancel the account. Okay, so irrecoverable debt expense will be shown in the credit side. For this also they have given one example. Like blacksmith's forge has shown the following information they have given. Opening inventory is 6,000. They have purchased goods worth 122,000. Closing is 8,000. Cash sales is 100,000. Credit sales is 70,000. Irrecoverable debts. They have shown 9,000 worth of irrecoverable debt. This is an important part of information. Debts paid in 2015, which were previously written off as irrecoverable, is 2,000. So they have shown 9,000 worth of debt as irrecoverable, out of which we have recovered 2,000 later on. Okay. So these two information which are shown in bold are important for us. Now what they are asking in question, when we will prepare SOPL, how to show it? The format of SOPL is known to you. Now revenue is 1 lakh, that is cash plus credit sales. Okay. Cash plus credit sales. Cash sales were how much? Cash sales is 100,000, credit sales is 70. So that make it to 170. Okay. So revenue is 170. To that we will show opening inventory is 6,000. Opening inventory plus purchases minus closing inventory. Opening inventory plus purchases minus closing inventory is COGS. Do you remember the formula for COGS? Cost of goods sold. Opening inventory plus purchases minus closing inventory. At this time, revenue minus COGS, we get gross profit. Revenue minus COGS is equal to gross profit. 170 minus 120 is 50. Now expenses. So irrecoverable debt expense will be, we have made a irrecoverable debt of 9,000, but we have recovered 2,000. So ultimately it becomes 7,000. Decrease in irrecoverable debt. Other expenses as given in the question is this much. We will deduct this. We get the ultimate profit for the year. Okay. Now in SOFP, we will show receivables as receivables were 24,000. From that, we will deduct 9,000. Receivables will be 15,000. So remember, see, in receivables, we are not showing this particular thing. We are showing irrecoverable debt expense as 9,000 only. Okay. So that was the first part of the topic, that is irrecoverable debts. Okay. Now we'll continue with the second part, that is allowances. Okay. So again, we should know the allowances. What do you mean by allowances? And in addition to irrecoverable debts, a business might make an allowances for receivables as a prudent precaution to account for the fact that some receivable balance might not be collectible. Now, this I will explain from here. What are doubtful debts? Sometimes we think like irrecoverable debts are specific debts which are definitely not expected to be paid. So here it is clear from the above topic we came to know that irrecoverable debts are definitely not expected to be paid. However, there may be some debts which the business thinks might not be paid, and these are termed as doubtful debts. So this word might not make it doubtful, not definitely unexpected. Okay. So what is a doubtful debt? Which can be possibly irrecoverable in future. Okay. As the word doubtful says, doubtful means we may recover it, we may not recover it. Okay. So doubtful debts may occur when an invoice is in dispute or when a customer is in financial difficulty. In this kind of situation, the debt is not written off because still the scenario is not clear whether we are going to receive it or not. Okay. So that's the reason it will not be written off, as it is not certain that the debt is irrecoverable. But because there is doubt over whether the debt will be paid, an allowance for receivables is made. So here we are getting another option for doubtful debts. We can show an allowance for receivables against that doubtful debt. So what is allowance? Allowance is impairment. Impairment means decrease in value. Okay. So an impairment amount in relation to receivables that reduces the receivables asset to its recoverable amount in statement of financial position. That means, like, suppose I will tell you, suppose we have debts worth $5,000. We are expecting that $50 may be doubtful. So we'll decrease the debt by $50. That means we are giving allowances for that. Okay. So it reduces the receivable asset to its recoverable amount. Okay. That means we know this 4950 is definitely expected. Okay. So we will show this as receivables. So it is offset against receivables which are shown at net amount. Okay. So this is receivables, this is doubtful, and this is the net receivables. Now, allowance for receivables account for potential irrecoverable debts is shown as prudent precaution. At the starting of this lesson, I said, na, we follow this prudence concept. That means according to accounting concept, it is provided that we can estimate the losses, but we can't estimate the profit.
Yes.
So as per prudence precaution, we can decrease the value of receivables. So business will therefore be more likely to avoid claiming profits which subsequently fail to materialize because some specific debts turn out to be irrecoverable. Now, so sometimes like when we study about Indian concept, instead of allowances, sometimes this word bad debt provision is used. But provision will not be a correct word. It's a wrong word. Okay. So here that's the reason this ACCA, they use allowances instead of provision. Okay. So provision is an estimation, and for provision we have a different lesson. Now provision is a liability. but allowances is decrease in value of asset. Okay. So that we have done in detail about provision in previous lesson, provisions and contingencies. You can refer to that particular lesson for knowing more about provision. Now, how to determine the allowances for receivables? Now, method which is followed is IFRS 9. And fortunately, these are beyond this level, so now you don't have to follow it. You have to only remember that IFRS 9 is for allowance for receivables. Okay. Now, allowance against the receivables balance is made after writing off any recoverable debts, irrecoverable debts. So, like net amount is of receivables is $5,000. Out of that, irrecoverable debt is some $100. So first of all, we will deduct this. We get 4900. From this, we will show the doubtful one. Suppose doubtful is some $50, so we'll show allowances for receivable as doubtful as 50. So now this will become 4850. So this is how it works. Okay. Now we will check about the accounting treatment. 1 second.